Hey everybody, thanks for coming today. My name is Jeff Gibby. I'm going to be facilitating the session. Welcome to today's class. Let's go ahead and get straight to it, shall we? Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using the specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Thomson Reuters shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. Today, we have a very, very special guest. In fact, probably the most popular, based on the attendance, presenter we've had in a very long time. Dr. Elder is somebody that I've had the privilege of working with a few times over the years. He's absolutely phenomenal. Every time he does a webinar, I try to be there. I really appreciate his view of the market, what he has to say about it. And certainly his backstory is awesome as well. So without further ado, we're going to go ahead and bring Alex on, and we're going to go ahead and get this session started. Alex, can you come on now?
Thank you, Jeff, for inviting me here today. And I hope you can hear me. Can you hear me? Yeah. I'm just looking quickly at the scrolling chat thing. You can hear me and you can see the screen. The screen is provided by Jeff, courtesy of MetaStock. So, what I would like to do today, these are truly and really wild times in the financial markets. So what I would like to do today is begin by reviewing the key stock market indices. We will look in sequence at the Dow, the Nasdaq, the S&P, and we will actually reach pretty far back. I want us to begin by looking first at the monthly charts. Let's take a look at the monthly chart of the Dow, which we will follow. We can just take a weekly and compress it to the monthly, I guess. We will take a look at the monthly chart of the Dow, then the monthly of S&P, Nasdaq, and we'll do the same sequence for the weekly and daily charts. And we'll try to come up with some kind of hopefully reasonably intelligent decision as to where we are on the market calendar, so to speak. What season is it? Is it spring, summer, autumn, winter? It'll probably take us 15-20 minutes to do all of that. 15. And then I'm gonna start asking you to tell me what stocks you guys are interested in looking at. And good old Jeff will be pulling up those charts, and we'll be looking at them, and that should keep us busy for the rest of this hour. Busy and off of the streets. So we're now looking at a monthly chart of Dow Jones Industrial Average. What you see on the screen is a fairly typical, well, not fairly typical, but absolutely typical setup that I like to have on my screens. You know, a powerful software package like MetaStock gives you a tremendous menu of indicators. And I think it's very important not to get seduced by this power, by pushing every button that MetaStock allows you to push. Because you never should forget that when you're analyzing markets, you're only dealing with 5 pieces of data: open, high, low, and close price plus volume. So using 10, 15, 20 indicators doesn't change anything. You're still analyzing the same 5 pieces of data. So less is more in market analysis. So when I analyze markets, I look at them using a pair of moving averages, a fast and a slow one, and you can see the red and the blue line right in the middle of the chart. I use an envelope, which automatically, it's actually part of the LD disk for MetaStock. We have this wonderful envelope which automatically fits itself to whatever trading vehicle we're looking at. And those of you who like using envelopes or channels know how difficult it usually is to fit an envelope. You go from the Dow, which is over 10,000, to some stock that's trading for $5, and all envelope settings go out the window, unless you're using this auto envelope, which really puts a perfect envelope on every chart. I have a brilliant programmer in Chicago, a man by the name of John Bruns, who programmed it years ago. I didn't know this could be done, but he did it. So, two moving averages, an auto envelope, and then in the second pane, you see one of my favorite indicators, MACD lines and the MACD histogram. MACD lines are, in a nutshell, a pair of moving averages, and MACD histogram tracks the difference between them. So if the fast moving average is on top, the histogram is positive. If the fast moving average is below, the slow one, MACD histogram is negative. And to me, the most important thing, actually one of the most important signals in technical analysis, is a bearish and bullish divergence. Bullish divergence occurs when the market makes a new low and the MACD histogram makes a much more shallow low. A bearish divergence occurs when the market makes a new high and a MACD histogram makes a much more shallow high. And in the bottom pane, we have an indicator called the force index, which is really based on the on volume. And I don't think it's tracing right with, by the way, with Dow Jones Industrials, because it looks like the force index runs out of data about year 2006. Strange and certainly not true, but that's okay. We can live with that. We can do without it. In any case, another absolutely key principle. So this is a very simple set of indicators. Tested over the years, works for me. You don't have to use the same indicators, but I encourage you to do the same thing. Find a small handful of indicators that make sense to you and stay with them. Instead of running around and trying to chat up a different indicator in a bar every night of the week and going home alone most of the time. In any case, we are looking now. Another principle, an absolutely key principle, is this: I want to analyze markets in multiple time frames. In other words, most people look just at a single time frame. Most investors look at a daily chart, and then a day trader may be completely glued to a 5-minute chart. And I think it's absolutely wrong. Markets exist in multiple time frames at the same time. And so I want to start with a long time frame and make my strategic decision there. Am I a bull? Am I a bear? And then I go to the so strategic decision is done in a long-term time frame, and then I go to a short-term time frame and I execute my strategic decision. Do I have an entry? Do I have a target? Those kinds of questions. So here, usually I use a weekly and a daily pair in swing trading, and I use 25 minutes and 5 minutes in day trading. But here, since we're looking at a strategic picture, I asked Jeff to get us started with the monthly chart. This is the monthly chart of the Dow. What does it show us? Well, first of all, it shows how when the market comes near its channel line, it's really near a reversal zone. If you can, Jeff, if you can put a line maybe in 1998, you can see how the market hit its upper channel line a little bit further to the right, a year. No, I'm sorry, go to 99. Further, another half a year. Jeff, I don't know if you can see my cursor. Probably not. Okay, well, approximately here. The market is hitting the upper channel line, and at this point it's exhausted. Then the bear market begins, and the bear market takes prices to the lower channel line. If you can put this line, let's say somewhere in year 2003. Then a new bull market begins, and where does it take prices? By 2007, it takes them to the upper channel line. And then, of course, we have a vicious bear market, 2007-2009 bear market, which actually takes prices below the lower channel line. You're starting to get an idea. If you want not to be stampeded by the crowd, when the crowd becomes hugely pessimistic, goes below the lower channel line, you want to start look at buying. And when the crowd becomes highly optimistic and goes to or near the upper channel line, you want to think about selling. If you look now towards the right edge of this chart, you can see there was a powerful rally last year, 2011, and the Dow came near its upper channel line, and right now it's trying to come near its upper channel line, and it's not making it, it's failing. Look at the middle pane and you will see what a MACD histogram is doing. You can see the height of a MACD histogram in 2011 showing tremendous power of bulls. You can see that at the end of last year a MACD histogram has gone negative. We call it breaking the back of the bull, and now at the right edge of the screen a MACD histogram is feeble. There is no other word about it, feeble. So we have prices at a new high and a very feeble MACD histogram. This month is coming to an end very rapidly. Early in the month, when the Dow was a little lower than today, this histogram actually ticked down. Today we had a nice rally, so MACD histogram is up again. But clear as a day, a bearish divergence, although not yet activated, is developing, and it's a nasty, ugly picture. Let's take a look at the monthly chart of the Nasdaq now. We looked at the Dow, which is a very narrow index. Let's take a look at the Nasdaq, a monthly Nasdaq. Now, looking at the monthly chart of the Nasdaq. Of course, Nasdaq is a story in itself, because back in 99, 2000, Nasdaq had this we had a tech bubble, and Nasdaq just went absolutely crazy, and it went parabolic, and it hit its head on the ceiling, collapsed, and has never come near that level. It will be a long time before it does. Actually, have a guess what will drive it back to those levels again. If we get a chance, we'll talk about it later today. But at the right edge of the screen, you can see how the Nasdaq is now trading outside of the upper channel line. That's a danger zone, ladies and gentlemen, a danger zone. Now, an average speculator looks at this and says, happy, happy, joy, joy. The Nasdaq is making new highs for this bull market. Yeah, it is making new highs for this bull market. But look where it is. It's in the overvalued zone. It's in the zone where up moves end. Look in the middle pane and take a look at the MACD histogram. Last year, 2011, MACD histogram was strongly positive, confirming the power of bulls and saying expect higher prices ahead. By the end of last year, MACD histogram has gone negative, breaking the back of the bull, and now it's positive again. But how feeble it is. It will take very little to turn it down, and when it does turn down, we will see a bearish divergence of monthly MACD histogram, which is a very rare signal and extremely bearish one. We're not there yet, but we're on the verge of that signal. So don't be too seduced by current market fireworks. Let's take a look at the monthly chart of the S&P. Somebody asked a question, is the envelope based on standard deviation of price? Yes, John, that's exactly how it's built. It's actually 2.7 standard deviations going back 100 bars. You know, depending on whether it's monthly, weekly, and daily chart. 100 bars, I find that 2.7 standard deviations works very well. Now, we're looking at the monthly chart of the S&P, and I cannot trade the monthly chart. I mean, just think about it. Every single little bar here represents a full month of life. I mean, who can wait for 5, 6, 7 bars to form something out? So I use this only for general orientation. I use this to help me decide: are we in a bull market or a bear market? Well, we're in a bull market for sure. And what you can see, the bull market began in 2009. With the S&P below the lower channel line in the oversold area. A typical bull market consists of 3 waves, 3 moves, and you can see those 3 moves very clearly on the charts. Now, I know eliticians love those waves. I'm certainly no elitician by any stretch of imagination, But this three-wave pattern goes to way before Elliot. Actually, Charles Dow, the founder of the Wall Street Journal, wrote that every bull market has three stages. First stage, recovery from crazy bear market lows. Second stage, an improvement in the economy. And the third stage, basically speculation. Everybody gets happy. Which is where we are today. What's very unusual about this bull market, usually the third stage tends to be pretty long, and here stages are getting shorter and shorter and shorter. So we're in the third and perhaps final stage of this bull market that began in 2009. Remember, a fairly standard bull-bear market cycle is about 4 years. So it started in March of 2009, 10, 11, 12. Bull market has been going for 3 years, a little more than 3 years now, 3 years and 2 months almost. So it's time for Mr. Bear to make his presence felt. And you look below, look at the pattern of a MACD histogram. Same thing, it hasn't ticked down yet, but it's absolutely on the verge of a very nasty bearish divergence. Now, let's go through the same cycle with a weekly chart, but faster, I hope. Let's take a look at the weekly chart of the Dow Jones Industrials. Someone is asking about day trading. Day trading is not for beginners. Day trading requires instant reflexes. If you're position trading and you don't know what to do with your trade, you can step back, think about it, go home, have dinner, wake up a little early in the morning before the market opens, think about it again. If you're day trading and you stop to think, you're dead. So day trading is certainly not a beginner's game. What I see on this chart, Jeff, if you could please draw a horizontal line across the top of 2011, across the top of last year. There are certain patterns in technical analysis, much higher, 2011, April, May of 2011. Yeah, that's it. Thanks a lot. A little higher, maybe just a tiny bit higher, really across the top. So a millimeter higher. That's it. Thanks a lot. I'm generally very suspicious of what they call classical charting, because when people start interpreting triangles, rectangles, and all these other wonderful things, I think very often they just they draw these lines higher, lower, basically expressing their own wishes. But there are certain patterns that work and work very well, and they're very logical. And one of these patterns is a false breakout. I don't think that charts remember diagonals. So all these diagonal trend lines I'm very guarded about. But people remember price levels. So this market, this Dow, has broken above the peak of 2011, and everybody realizes that's a bull market. We have broken above the previous bull market peak. And what's happening now? What's happening next? Well, prices are stalling out. And they rallied today. Maybe they will continue to rally. Stranger things happened. But to me, this is a market at the edge of a precipice. Why? Because if prices close below the lows of 2011, and they're really just a few Dow points above that level, if they close below, they will leave behind one of the most bearish signs in technical analysis, a false upside breakout. A market that breaks out to the upside, cannot sustain that break and pulls back in, is likely to go in the opposite direction. If it failed to take out the highs, the next thing it's most likely to do is to take out the lows of 2011 in this case. So I would say the weekly Dow at the edge of a precipice. Let's take a look at the weekly NASDAQ and do the same thing. Let's draw a line across the top of 2011. I see a question about head and shoulders. You see, that to me is precisely the kind of thing I try to avoid. This head and shoulders toes and nails and all this other all these other things. You know, if I squint long enough, I will see Head and Shoulders. But the moment I catch myself squinting at a chart, I get very cautious, because you know all these patterns, triangles, rectangles, heads and shoulders, they're so subjective, so terribly subjective. But when you draw a horizontal line across a historic peak, well, then there is not too much subjectivity in it. Back to the chart of the Nasdaq. Nasdaq is certainly much stronger than the Dow. You can see that Nasdaq has cleared 2011 highs very convincingly, and it's trading substantially above them. And the latest peak of a MACD histogram is very strong. So Nasdaq is actually being quite bullish in this chart. Nasdaq shows a pullback to value. I call the space between the two moving averages the value zone. Nasdaq shows pullback to value and ready to go up again. So count Nasdaq as bullish. Let's take a look at the S&P. Man, it's so pleasant when all indicators point in the same direction, but unfortunately most of the time they're in conflict with each other, so we have to come up with some kind of decision how to combine their signals. We're looking at the and let's draw. Okay, thanks Jeff. S&P, the pattern of the S&P is much closer to that of the Dow. The S&P broke above 2011 peak and it stalled out. It's stalled out and it's stalling at this level. It's another index that's at the edge of the precipice. So I would say well, let's take a quick look. Let's go through a quick swing through the daily charts, and then we'll try to pull all of this together. So the daily of the Dow. I see someone is asking a question. What moving averages are the blue and the red? I usually draw fast moving averages in red, fast moving averages in red, and slow in blue. For a slow moving average, I like something like 22 days, which is the number of trading days in a month. Fast moving average, maybe 13. Only exponential moving averages, never simple. And also keep in mind that these parameters, 20, 22, 25, 20, not much difference between them. It's not like, you know, one number is good, another is bad. I suggest you get a number, you know, just try a few different numbers, see which of them trace your stocks better. That's about it. So the daily chart of the Dow. Not a happy looking chart, because Jeff, if you draw maybe draw a line across the February highs, February of this year, a little lower, much lower. You're drawing them across March. Yeah, keep on going down. Yeah, right around here. Okay. So what you can see here on this chart, and also Jeff, let's draw a line at the August 2011 low. As I said to you a few minutes ago, I consider a false breakout one of the strongest signals in technical analysis. The market goes to support line, breaks through it, stays below for a day or two, cannot hold that level. Well, the next thing it's going to do, it's going to go up and test the upside. So these false breakouts actually are fantastic, wonderful tells about which way the market wants to go. And you can see how a false breakout in October really launched this whole bullish move. So what's the market doing now? It established a high in February, and it broke above that high in March. And take a look at the MACD histogram. Compare the height of a MACD histogram and the MACD lines to where they were last year. You have bearish divergences leaping at you from this chart. Let's take a look at the daily chart of the Nasdaq now. Remember, the weekly Nasdaq is very strong. Let's take a look at the daily. Jeff, if you please put a vertical line through the peak of a MACD histogram at the very beginning of 2012. right around here, and then another in mid-March when MACD histogram went positive again. You see, this is a pattern. This is a very strong bearish divergence. At point A, at the first line, you can see tremendous explosion of the power of bulls, tremendous bulk and height of a MACD histogram. Then a MACD histogram goes below zero. I call it breaking the back of the bull. And then in March, a MACD histogram comes up again. Compare its height in January and in March. That's a divergence. For those of you who are interested in the concept, I have this ebook, Two Roads Diverge, Trading Divergences. You can download it, of course. But this is a divergence, just leaping at you. What happens afterwards? On the daily chart, the Nasdaq sells off and makes a very deep bottom of a MACD histogram. Today it rallied again. Well, Apple, of course, was the primary driver, but technically it still looks feeble. Looks feeble to me. Let's take a look at the daily chart of the S&P, and then we'll try to pull all of this information together. Someone is asking me, I use divergences on MACD. He uses stochastics. You know, for me to really, for a divergence to be valid, an indicator has to have a zero line. Stochastic doesn't have a zero line, so divergences in stochastic, I don't know, maybe they work for you, but I certainly haven't paid too much attention to them. So I look at the MACD histogram all the time. Force index as well, another indicator that has a zero line. So this is the chart of the S&P, and you can see the same pattern of a severe bearish divergence of a MACD histogram, severe break of a MACD histogram near the right edge, and then at the very right edge today we're having a rally. So pulling it all together, I would say on the monthly charts, the Dow, the S&P, and the Nasdaq are all bullish, barely bullish, and also at the edge of creating a bearish divergence of a MACD histogram, which is very rarely seen on the monthly charts. Really a very rare figure. So a monthly chart is flashing yellow, a very angry yellow signal. We'll look at the weekly charts. The weeklies all show upside breakouts. The Dow and the S&P are flashing major danger signals. The only positive indicator is the Nasdaq. And on the daily charts, it looks like dailies are starting. Dailies have broken from a bearish divergence in all three indicators. So, having said that, I would have to say that I think we're approaching the tail end of this bull market. Very dangerous time, and also a time of great opportunity. It's a time to absolutely protect profits on your long positions. If we do in fact go into a bear market here, which will last for a year or so, you don't want to be sitting on losing stocks for a year, 2, 3, 4, waiting for them to come back to even, the way so many people do. So this is the time to protect your profits. It's also a time to start planning what to sell short. Which stocks appeal to you on the short side. But you want to be very careful with this aging bull, because bull markets, the tops tend to be fairly broad, bottoms tend to be sharp, but tops tend to be fairly broad. I would not be even terribly surprised if the Dow goes and makes a new high for this year, betters its previous high by a few points, just brings a little more cheer to the crowd. So I'm watching these markets and I'm saying the bull market is nearing its end. Protect profits and trade very carefully, both long and short, but very, very carefully. That's pretty much the summary of what I wanted to say, of what I see on these charts and what I'm sharing with you. Really, what I'm doing during this webinar is thinking out loud, sharing my views and opinions with you. I certainly don't possess any kind of magic crystal ball. I wish I did. I mean, if somebody has a magic crystal ball, please send me an email. but I think about these markets all the time, and today I'm sharing my thoughts with you. Um, so uh, um, um, Another thing, if you um, as you may know, together with my friend and business partner Kerry Lavon, I run this group called Spike Trade, which has a blog which is completely free. You ought to visit that blog and take a look. We posted a set of charts a few days ago, maybe a week ago. One of the members, one of our group members, an Australian, sent us a set of charts of the U.S. stock market during presidential re-election campaigns, when Bush the father ran for re-election, when Bill Clinton ran for re-election, when Bush the younger ran for re-election, and all three of those charts have a very similar pattern. Of course, now we're into another re-election campaign. Generally, a re-election campaign, according to those charts, tends to put a lid on prices, and prices stay depressed, usually making a low in August. But don't take my word for it. Just look up Spike Trade blog, find those charts, take a look. I was very impressed when that guy sent me those charts. I wrote some commentary and posted them with commentary. So once again, I think we're at a dangerous time in these markets. It's not the time to be aggressively bullish. It's time to be extremely cautious, protect your profits, and start looking for shorts. Let's take a look at a few markets, maybe. Well, how about, yeah, INTC. Would love to take a look at INTC because I happen to have a short position in INTC, which is certainly not doing as well today as it was doing yesterday. So that's something to look at. We're looking at Intel. Jeff is pulling up the chart of INTC, weekly chart for it, of course. First, that's to me that's a very important discipline. I am not allowed to look at the daily until I looked at the weekly first, because it's so easy to have your eyes prejudiced. You look at the daily chart, you form an opinion. Next thing you know, oh, let's take a look at the weekly. Well, it's too late to look at the weekly. Your vision has already been poisoned, so to speak, by the daily chart. You can't be objective looking at the weekly. So here, let's open this chart a little bit, kind of zoom in, I guess the word. Open it up a little bit, Jeff. Weekly chart of NTC. Thanks. That's good. No, too much. Way too much. Way too much. Way too much. That's it. So the weekly chart of NTC. You can see how in August of last year, well, we'll go a little bit back. In April of last year, Intel made a low. In August, it took out that low. False downside breakout, which launched this whole up move. Look at the pattern of a MACD histogram, how it keeps getting weaker and weaker and weaker. Look at the channel lines. Look how Intel used to just blow above those channel lines a lot, and then medium, and very little now. So it looks like the upside inertia is becoming weak. So looking at this chart, I'll say to myself, well, we have an overvalued stock in a weakening market. If you look at the chart of force index below, you can see really how much weaker it is. So count me as a bear on Intel. Let's take a look at the daily chart. Take a look at the daily. And take a look at what happened, what was it, about 7-8 days ago, when Intel jumped to a new high. You see this bar where it jumped to a new high, this little green bar, 1, 2, 3, 6 days ago. How does it look to you? The stock breaks out to a new high, and look at this bar. Each bar tells a story. You can see on this bar how it opens flat with the previous day, spikes up, fails, and closes near its low. Next day it gaps further down. Take a look at a MACD histogram. Take a look at the height of a MACD histogram back in January, how it goes below zero in February, March, breaking the back of the bull, and it tries to rally in March, and in April it can't even go positive. Massive bearish divergences. So this to me is the kind of stock I like to sell short. I'm short. I'm short and I'm profitable on the thing because actually I sold it pretty high. But I have a very strict rule. Don't allow a profit run into a loss. If you have a profitable trade and that trade starts going against you, like Intel Intel went up almost 50 cents today, 53 cents if memory serves right. Put a protective stop at a little bit better level than your entry. Book some profit, book some little profit, but don't. I mean, if you short a stock and it's in your favor by 10 cents, well, you still have to accept risk. But once it's in your favor by $1, don't give back. You cannot allow it to become a loss. So you have to put a hard stop in a position like that. That's my view of Intel. What else are we being asked for? Jeff, you're probably watching the thing more attentively than I do. Any suggestions? I see a couple of people ask.
The next suggestion we have is Cisco, or actually gold, oil, Apple came in as well.
Yeah. Let's take a look at Apple. That's a fascinating stock. Happens to be another stock in which I do have a position. And by the way, my advice to everybody is when you have a position, don't tell people what you have. Don't tell people what you have because then you're going to be protecting your opinion instead of analyzing them objectively. And of course you can ask, Alex, how come you're talking about what you have? For only one reason. After doing this for many years, I have skin like a hippopotamus. Other people's opinions just simply don't bother me anymore. So I just look at the charts. Apple. Apple has gone parabolic. Apple has gone completely and absolutely parabolic outside of the channel line on the weekly. But you can see, well, for those of you who use the impulse system, you can see how the color changes. The impulse goes from green to blue. Let's go to the daily chart of the Apple. I take a little pride, some pride, in having shorted the Apple on the day it established its lifetime high. Just this bar, Jeff, maybe you can put a little vertical lines through it, the tallest bar here. Why I did it? Well, because I saw this massive, fantastic. Well, first of all, I knew that it's a stock that everybody loves, and I want to be a contrarian trader. Majority has to lose money. It's only the savvy minority that can win. Look at the massive bearish divergence. Look at the peak of a MACD histogram a month earlier, breaking the back of the bull, and then a feeble peak on the day that Apple reached its lifetime high. A MACD histogram could not even come above zero. So when it started coming off of that peak, I'm short from 636.70. So rounded off 637. And Apple has been going down, but to me, being short Apple, it's like catching a very large fish, and it's a fighting fish. So you can see how 5 days later Apple had this $20 up day. And when you hold a short position and it goes $20 against you, it's not a pleasant day, but that's the game. Yesterday I was thinking, should I cash out and look to reposition short after the earnings come out? And that's what I should have done. I didn't do it. I said, nah, what if there is a really bad surprise? Well, there was no bad surprise. There was a good surprise. So Apple shut up today. And I'm looking at this thing. Position is profitable, and I'm playing with market's money. I have a hard stop in. This trade cannot be a loser for me, but to me this is how I go into shorting these things. Now, if Apple continues to rise, I will get stopped out, get a little profit, and I'll be looking for another short. There is nothing wrong with trying to approach the same stock 2-3 times. That's what many professionals do. You know, beginners often approach a stock like they approach a girl in a bar. Try to talk to her, and if she pays no attention, they never talk to her again. And professionals will attempt to get in once and two times until they finally get a good entry and a good follow through. So short apple, I am short apple. Let's take a look at gold, a fascinating market. And maybe, Jeff, let's take a look with, I don't have a position in gold at this time, but I'm watching it every day. Who doesn't? Let's begin with the monthly chart of gold. I mean, on a fundamental level, gold makes a ton of sense because the governments all around the world, from United States to Bangladesh, all governments are printing money like it's going out of style. But they're not digging up much gold. And in the long run, ultimately, gold is the money. As a child, I grew up in Eastern Europe, and I knew people whose life was saved because they had a little gold when it mattered. And those who didn't have it died. As simple as brutal and as simple as that. So gold is real money, and there's not very much of it in the world. You know, if you were to take all gold that has been dug up and that exists in storage today, in people's hands today, you know how big that thing would be? All gold in the world. 2 Olympic swimming pools. That's it. So when I hear about all these wonderful ETFs like GLD and whatnot, that they have gold in warehouses to back up all these huge numbers of shares that they sell. So that sounds like a wonderful story. Wonderful story. You know, right up there with the Easter Bunny. So if you're gonna do gold for safety, do physical gold. But coming back to the chart, if we can open this chart up, so they say zoom in, so it's stop. Okay, here. You can see that what gold likes to do, it likes to have a strong rally, and then it takes a year or two to chill. There was a rally like that in 2006. Jeff, maybe you can put a line. Yeah, right here, this little green bar, little finger. No, much earlier. Yeah. Here, there was a rally here. Unfortunately, your line. Maybe better an arrow than a line, because your line actually covers up the most important bar. Thanks, Jeff. Let's take the line away. And then there was another, and after that the market rested for over a year. Let's put an arrow just pointing down from above. I think this way it's easier to see. Then there was another big peak in 2008. And now, of course, there was a huge peak in 2011, and I think the market is simply not done resting. I think gold wants to go higher eventually, but I don't think it's happening just yet. Not just yet. Let's take a look at the weekly chart. Well, if you look at the weekly chart of gold, you can see this crazy peak that gold blew out of the upper channel line, and it's really going flat, nowhere very fast. It's a dangerous market to trade, responding to all kinds of fundamental fears and technical stuff. So once in a while there is a nice little day trade in gold, but for those of you who are long-term holders, I think we don't have a buying point yet. It will come, but I just don't think it's here yet. I'm looking at my clock, Jeff. It's past 7 o'clock. I know we started a little late, but we were planning to run this thing for 45 minutes, and I think we've done it. So unless I'm missing something important, tell me. I'm just going to say a few words to say goodbye, and we'll probably wind it down. How about, Jeff?
That sounds great to me. You're doing a great job, and I can hear you very well.
Thank you, Jeff. And also I hope that those who were disappointed couldn't get in, they will get a recording of this webinar. In conclusion, let me say we reviewed broad markets. We looked at the monthly, weekly, and daily charts, and the point I was trying to make to you was that the technical signs indicate that in the very big picture we're approaching the tail end of a bull market that began in March of 2009. As your mom and pop told you, all good things must end, and so I think this bull market is ending as well. We're facing an approaching bear market, and then another bull market, but that will come. That will come later. I showed you the technical signals and signs that lead me to believe this way. I publish my research all the time at spiketrade.com. So for those of you who are not familiar with this website, Spike, SPIKETRADE, spiketrade.com. Come and visit us. It's really worthwhile. It's a worthwhile place for serious traders. And I thank you once again for having come to this MetaStock webinar. To me, it's always a great pleasure of working with MetaStock. Just a few months ago, I was in Singapore running a MetaStock seminar. I think we had 1,100 people. It was a great deal of fun. And of course, I'm grateful to MetaStock for making my tool package available. All the stuff you saw on the charts, the moving averages, the envelopes, the impulse system, which we didn't get a chance to discuss, and much, much more. But I don't want to do too much marketing, so I'll thank you once again for coming here, and I will see you again in the future, and I'm going to turn the microphone to my good old buddy Jeff Gibby.
Thanks, Dr. Elder. Always a pleasure to have you in here. Always one of the people I have a lot of respect for in the marketplace. I'd recommend both of his books. They're awesome. We did spend quite a bit of time, Dr. Elder and John, putting together all of the indicators that he talks about in both of those books. It's definitely an add-on that I would recommend, and definitely one that I have a lot of respect for. So right now, we'll give it to you on a money-back guarantee. It's a 30-day money-back guarantee, and it's only really $200. Really very, very cheap for the amount of indicators and systems and methods that are in there. Dr. Elder, thank you for coming today. Thanks for being here and talking about your methods and how you like to trade. And everybody, thank you for coming. We appreciate you having you. I'm sorry that we started a little bit late. We didn't anticipate exactly how popular Dr. Elder was going to be, but it was good to have him here. Thanks, guys. We'll see you next time.